Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is Monday morning, February 26th, and this is The Talking Point. Thanks so much for joining me. This morning, as I look at the market open, it looks as if it may have a bit of a struggle in the morning, but as we know, in a market where the earnings are still coming in, particularly from the retail side, retail Macy's, retail Domino's, just to give you an example, Best Buy, I could go on and on. We also have still some more important tech names, Salesforce, for example. So the market is still not finished with earnings, but remember, we had the big one. The big one came out last week, and obviously that was NVIDIA with a striking top line, bottom line, and guidance. And what it suggested was that they are absolutely the go-to for infrastructure, artificial intelligence infrastructure. And as the CEO said, AI is at the tipping point, meaning more and more is to come. Now, clearly that helped the market. There was no doubt about it, because there were concerns that they may have a very good report, good guidance, but it wouldn't be enough to satisfy a voracious market that wanted more and more. But clearly, it worked. Now, this week, again, we will go into all of these retail-related names. This morning, for example, we had Domino's, and what I focused on, I wanted to hear what they had to say about prices. And they said prices have come down. Obviously, the food prices. That's important for a company like Domino's. So all of this is important as we try to assess this week where inflation was and perhaps where the market thinks it's headed. What we know is this: the Personal Consumption Expenditures Index, that's the PCE. The information for that index comes from businesses as opposed to the Consumer Price Index, the CPI, which comes from surveys based on what consumers have to say. What we're looking for above all else is, where is that core and super core? Is it a 2.9? Is it coming down? Or is it climbing higher? Why is this so important? It's important because this market, as everyone knows, was hoping and basing its expectations on a host of cuts, interest rate cuts from the Federal Reserve. The Fed has pushed back on that, and let's just face it, the CPI report, when it came out, showed acceleration of prices. And we also saw, and we will see again this week at the end of the week, that when we hear from the manufacturing indexes, Philadelphia Fed, for example, the Empire Fed, we see that prices have climbed higher. The Producer Price Index, by the way, that came out after the CPI indicated that prices paid, prices received higher. So the market is concerned that the Fed may not feel comfortable enough to cut rates until perhaps June, because when we pay attention to the Fed funds futures market on probability of easing, now it looks as if June, it looks as if May not be in play. But things could change based on this week. If the PCE, Personal Consumption Expenditures Index, comes in cooler than expected, perhaps we see a recalibration of what the market says that the Fed may do. Keep in mind, all of the Fed speak that we have heard and looked at doesn't say there will not be a rate cut this year. No, they just say, we have to wait before we can declare victory on inflation. But they didn't come out and say no rate cut this year, because that would be really hard for the market to digest. They have just said we want to be careful before we initiate interest rate cuts. And so again, Thursday morning, you'll hear from the Personal Consumption Expenditures Index. This is extremely important for the market. And the consensus, however, is that it will be higher than what the market wants. So this is going to be an important data release. And then, by the way, on Thursday afternoon, we will have more Fed speakers. And then on Friday, a full roster of Fed speakers. I mention this because the Fed speakers have by and large spoken in unison. They have had an orchestrated message for the market. And that is, We are not yet ready to declare victory. We are going to be careful, but no one has come out and said, no, no rate cuts this year. We haven't heard that at all. So we're paying attention to all of the data. I also want to add one thing in terms of prices. Acceleration of prices or deceleration of prices. On Friday, the Institute for Supply Management, that is the ISM, Purchasing Managers Index, the ones that we pay very close attention to. We pay attention to the service side and we pay attention to the manufacturing side. They're coming out with their report on Friday, and we're going to pay attention to whether or not prices have receded or have prices climbed higher. What we pay attention to is prices received and prices paid. So let's pay attention to that because the Treasury market will be paying attention to that very, very closely, as will the equity market. In addition to all of this, we're going to have the durable goods numbers this week. And remember what we look for, the component within that has to do with corporate spending, capital expenditures. So we'll pay attention to whether or not companies are feeling more comfortable to increase their capital expenditures. Also, we are following always the labor market. And so far, despite the headlines regarding more layoffs in technology, more layoffs in financial services, the initial unemployment claims reports that we are seeing and continuing claims reports remain healthy. And, we pay attention because if we look at one number in terms of the labor market that gives us an indication of struggles within the labor market before the actual payroll report comes out, it is initial unemployment claims. So they are still suggesting that this labor market remains solid and resilient. Why is that important? Because consumer spending represents, as I always say, about 68% of our GDP. And much of that is based on the labor market. Do I have a job? Does my family have a job? And so on. It's logical. Also, I do want to point out that this week we will have some reports coming from the housing market, but I would have to add, it's Thursday morning, that PCE report. The market, again, is hoping that it comes in cooler than expectations and that, in essence, it refutes what we heard from the Consumer Price Index and the Producer Price Index. That's really what the market is hoping for. But again, we'll keep our eye on the reaction from the 2-year Treasury yield, which is the one most closely associated with actual monetary policy, and also the 10-year, where the mortgages, the loans are based on that. It's going to be an important morning, and it's going to be very important for the overall tone of the market as we go into March, by the way, which tends to be difficult in terms of seasonality. February is, and March is as well. But in an election year, it is particularly historically, in terms of historical patterns, a difficult month. Markets don't like uncertainty. We have issues on the debt and so many other things, but also in terms of the actual politics involved, that the market becomes, again, more sensitive. That's just the historical pattern, but normally those patterns in terms of seasonality do actually present themselves, again, as I said, particularly in an election year. Overall, the earnings have been good. The revenue has been picking up, and the question will be whether or not this week of retailers coming in and telling us how are people spending their money. It's going to be important. Now, one thing we do know is that we as Americans have been spending more money on services. You look at the receipts from many of the restaurants, the bars, they're actually holding up. But this week, it'll be more on actual stores. It'll be, whether or not we're online more than we are actually going into the malls and the brick and mortar. It's going to be an interesting week for the market. But again, Thursday morning, 8:30 Eastern. That's the one to watch. Have a very good week. We'll be back next week. Thank you again. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.